you find it of interest and relevance for our future endeavours together. As I kick off, I'll acknowledge the traditional owners of the land in which we meet around the country and pay our respects to their elders past, present and emerging. I'd also like to welcome all to the meeting. Returning clients and guests, welcome back. Thank you for placing your trust in us again and your continued support of the PKF firms around the country. Particular warm welcome to those of you joining for the first time. Welcome. Please tell all your friends this is the place to be, and we hope you enjoy it as well. Today's session, we're going to cover off, again, as it says on the tin, updates in the financial reporting landscape. There's been a few, which perhaps less around technical, but more around interpretation and enforcement, and we'll hear about that. We'll talk about the emerging trends around AI and what it means for either of us on each side of the table. And again, the ever-present topic these days of ESG, with the reporting timelines coming fast for some people at the end of this month, and those of you following on later, again, some things to get ahead of and prepare in that space. As I pick off those comments, it is incumbent on us to mention, as some of you already noticed, it is a heightened regulatory environment. Which means we do need to make sure we are alert to that, again, on both sides of the table. So there's mutual understanding of what each of us has to do, and particularly what has to happen when things don't happen on time. There's a teaser. We'll have to talk about that as we go through the session, as we go through. My other introductory comments, for those of you that joined us in our last session, and I know some of the attendees were particularly keen on my phrase around sufficient appropriate audit evidence. That might feature again today. It is the phrase of the time. It's incumbent on us to gather that as we go around our work, and similarly for our clients to be able to prepare that evidence on a timely basis. That's not meant to be the fun police. It just is the rules of engagement. And again, in terms of the enforcement activity that we're seeing, it will feature during the course of this presentation. This goes back to the age-old phrase of prepare, prepare, prepare. Plan, plan and plan, and sometimes please do plan and prepare early so that we're all in good shape. So there's in the spirit of Sesame Street, today's session is brought to you by the letter P. So I'm going to introduce Jim Allenby from an ESG perspective later in the session, but we're going to kick off as usual by handing us the meeting over to the safest pair of hands in the business, which is Carmen Ridley, to take us through what's happening on the financial reporting landscape. As always, if you have questions, please put them in the chat box. We'll keep an eye on them, and hopefully we can have a good conversation as we go through this session. So welcome again. Hello, Carmen. What's happening?
Hi, Ken. Thank you and welcome everybody. So let's get started and kick off. As Ken said, please strongly encourage questions throughout so we can answer those for you. Let's get started with the new accounting pronouncements as we always do. Now, the great news that I have for you is I'm not talking about new standards. I'm talking about a new standard. And the even better news is that standard is very unlikely to have impact for the vast majority of you. So consequently, while we are going to talk about it briefly, I'm not going to announce anything major for you. So let's have a look at what this standard is. It's called lack of exchangeability, and what effectively it does is it talks about where you are transacting in a currency that may not be exchangeable, possibly because it's hyperinflationary. So we're thinking about how do we actually translate it to our presentation currency if it's moving constantly. That's what the standard says. So it's an amendment to the foreign exchange standard, AASB 121. Now, whilst I don't think it will have much impact for you, hyperinflationary economies seems to be a bit of the topic at the moment for the International Board, because what we've also seen is an agenda decision that deals with assessing indicators of hyperinflationary economies that just came out in July. Many of you probably have got no idea that we have an accounting standard that deals with hyperinflation, and that's AASB 129, its international equivalent IAS 29. So within that, we've got guidance around, do we consider one indicator, do we consider all of them? Again, not really much impact, but I thought it probably was worth sharing what is a hyperinflationary economy. So this is the latest list that I have found that has been published. You may transact in these countries, but if you do not transact in their currency, it's not an issue. So for example, if you transact in Argentina, but all of the transactions are in US dollars, it's not an issue. It's only if you're dealing in those particular currencies. So that's it for the new accounting standard for the next reporting period, and probably in that June reporting period as well, unless anything else is snuck through.
Alan, just obviously that's an interesting list, and as you say, some of our clients may not think they're directly exposed to them in the natural host currencies. But just perhaps is it worth reminding about supply chains, and some of these currencies may be in a supply chain 2 or 3 stages away from you directly, but that could have an inflationary impact on your transactions, not necessarily inflationary accounting to keep an eye on. So I just thought just we had a thought on how it plays out in supply chains.
Yeah, and that's a good point. Prices may be rocketing because somewhere along that chain, one of your suppliers is sourcing from one of these countries in their home currency. Yep. All right, so as Ken alluded to, we are going to spend a lot of time in this session on a regulatory update. Although we've got no new standards, ASIC effectively came through with the goods and gave us lots to talk about, not necessarily in a good way, but we have got lots of information that has been recently released from them. So I'm going to refer you to a few reports as we go through and effectively give you some real headlines with lots of references for you to do deep dives if something is particularly of relevance for you. So let's start off with ASIC Report 819. This is an integrated report. So the last few years, they've issued integrated reports between financial reporting and auditing. So what used to happen is we used to have their financial reporting surveillance team here picking whatever sets of financials they wanted to review. And then we had their audit surveillance team over here picking whatever audit files they want to review. Now what they do is they pick the financial reports. Some are random, some are risk-based. And if they find an issue in here, they then explore the audit files. So we've seen that there's a lot less audit files being reviewed, and ASIC have been very heavily criticised for that. We may see that list increase significantly. Let's watch this space. The 254 financial statements have been reviewed, and I guess one of the really important comments in here is they are looking at large proprietary companies. It is no longer that they're focused only on listeds. There are large proprietary companies that we need to consider. If I talk about the comments that were made at a really high level, and then we'll drill down into some of them a bit more. So if we work through those boxes, the first one in relation to the OFR, so it's the Operating and Financial Review for those of you who are not familiar. If you're not familiar, probably means you're not listed. If you are a listed entity, you should be very familiar with the OFR. And within that, you have to report on material business risks. This has been something for a few years now that ASIC are really focused on. They have got lots and lots of entities who they've required to change their material business risks. So what I would tell you is if you are in a position to be preparing this, make sure that your material business risks are really specific to you. Make sure that they're not necessarily exactly the same words that you wrote last time, and make sure that you're also considering macroeconomic risks, such as your geopolitical risk, your cyber risk, your environmental risk, etc. The next one was 2 entities were agreed to make changes to their financial report disclosures. One of them was about consolidation, and we're going to keep coming back to consolidation through this session. The next one was about breaking out material balances in the balance sheet. So it's hitting that balance between making sure we're giving enough information and also not just repeating what's in the balance sheet and not giving this great big note that contains lots of immaterial information. The last one in this section is actually a little bit scary considering what we're looking at is listeds and large proprietaries, and that was ASIC asked an entity to prepare a cash flow statement. Now, I'm not sure how an entity has managed to prepare their financial report in the large or listed space and have them audited and not include a cash flow statement. So I am sure that all of you listening properly prepare the primary statements that you should. Please make sure that you definitely are doing that. Again, in the listed space, some comments on non-IFRS profit. So we do have a regulatory guide issued by ASIC that gives us some guidance around if we are reporting non-IFRS results. So that could be EBITDA, it could be underlying EBITDA, it could be whatever profit name we're choosing to report because we don't like the IFRS results. We obviously have to reconcile those results to the IFRS results and give some explanation. Going forward, when we do have the new standard AASB 18 in place, all of that will actually be brought into the notes to the accounts. So it will be very clear and it will be audited. But as we stand at the moment, wherever you're reporting those non-IFRS numbers, we need to make sure that we are complying with that regulatory guide. The last one I'm going to talk on this slide is in relation to the income statement. And this was a particular entity that had netted their employee benefit expenses. So just making sure that it was appropriately disclosed. That was okay. That's appropriate treatment. But they'd actually grossed it rather than netted it on their presentation. So fairly minor, didn't change the result, but it was just purely presentation. The other two at the bottom of that box, I'm actually going to talk about in a bit more detail a little bit later on. I actually find in many ways that Report 819 is actually a helpful document, and I would really encourage all of you to have a look at it. What they have done is they've given some information about what companies should do. Now, I'm not necessarily going to talk through this slide. Some of my slides have got lots of words on them. They're more for reference for you afterwards. But when we've got the corporate regulator telling us what companies should do in the financial reporting space, companies should do what they're telling us to do. So if we look, for example, at the first one in relation to impairment, it tells us that companies should make sure we've assessed all indicators of impairment. So consequently, whether you're an ASIC entity or not, I would be expecting your directors or your audit committees to be asking the finance team, have we assessed indicators of impairment, and where's the document around that? So I think this information is really useful and certainly can be pushed up to the directors, to the audit committees, to make sure that we are looking so we aren't having the same mistakes that they're finding for other entities.
I just might come in there, Carmen, just on that one in particular. So I'm going to be very careful how I articulate this because I don't want to speak on behalf of the regulator, but in our discussions and liaisons with them, the following message has been handed out. We have made our regulatory enforcement areas very clear. And what they mean by that is we've told you this is what we don't like. There's an expectation, therefore, well, if we've told you, we don't expect you to make the same mistakes again. Be warned from this point on, address these points. I guess that's a plain English way of interpreting some of these reports. So for the slide that Carmen up had a second ago, and for these ones here, I guess up front for the PKF teams on the call, every audit plan should have that slide in it, even if you're not listed, because it was listeds and proprietaries. And then to Carmen's latter point, every client should be looking at this saying, how have we considered this? Carmen said the boards and or committees should be saying, do we have a paper on impairment? I guess going back to my plan, prepare. Please don't hand that paper to us on the day that you want to sign the accounts. That's the point about the preparation and the planning here. So we are seeing some people try and do this very last minute. So it's great that they're leaning into these issues, but please do them earlier. It makes for stressful period otherwise. So I've possibly said that before. I'll probably say it again, but that's, I guess, the practical implication of this slide and the one that came before it.
Yeah, and the one that was going to finish off on before we move on from this. And again, I've just pulled this together at an overall comment that they made on financial reporting and highlighted some of those words in bold. So companies and other entities should ensure they've got the right expertise and resources devoted to the preparation of financial statements. I know that sometimes we go, it's once a year, it's a pain, we have to put together these financials. What are they used for? Who looks at them? But we are required to do them if we're preparing them. So consequently, let's make sure that they stand up and are relevant and useful information. Estimation, uncertainty, and judgment. We are in a really uncertain world at the moment. So consequently, we are seeing lots of inputs, estimates, judgments that maybe aren't the same as what they were last year. And maybe we've spent a fair bit of time trying to think about what this should look like. So making sure we've documented that, making sure we've disclosed it where relevant. Lots of the times when ASIC send letters to companies asking for a please explain, it's because there's not enough information in there. Much better off to put an extra sentence or two in your financial statements and avoid that letter from ASIC rather than put less information, spend a significant amount of time, cost and effort dealing with ASIC. So I said that I would come back to two of those comments in that previous box with previous slide with lots of boxes. These are the two restatements that have happened recently. The first one is actually from 2024, and the reason that I'm talking about it now is, to be honest, I actually missed that it was a misstatement, and it become more emphasised when they kept adding to this media release. There's lots of editor notes have been added to it over the time. So what happened initially? This particular entity applied for a reduced content prospectus, and ASIC said, no, you can't issue one. And the reason for that is because ASIC suspected a breach of the accounting standards. The particular auditor here had qualified their audit report since 2018. This entity operates in exploration assets, gas projects, etc. The reason that the qualification happened was in relation to those really key core assets. This entity, now having been restricted by ASIC from issuing a reduced content prospectus, ended up with a very significant impairment, $794 million of those really core operating assets. So I guess my message there is impairment is really important. We've just spoken about it. But also, if you're putting your head above the pulpit to assure ASIC to say, here, can we do this? Then they're very much still scrutinising those financial statements. The next one is in relation to a consolidation issue. And I have a concern, based on lots of the queries I get asked, that people seem to think, no matter how many times I say it, that there's this magic 50% rule for consolidation. And if I don't own 50.1%, well, I can't possibly control it and I can't possibly consolidate. There is no such rule. There never has been such a rule. So in this particular instance, there was an entity who held a 45.6% shareholding in a listed entity. ASIC came in, did some research and investigation into it, looked at the remaining shareholders. They were widely dispersed, which means a lot of them would have had to come together to outvote the 45.6% shareholder. So consequently, when we look at that definition of control, we're looking at power, exposure to returns, and do we have the ability to affect those returns? ASIC deemed that yes, they did. This particular entity, having looked at it, obviously agreed with it and then consolidated that subsidiary. Some fairly big numbers that were brought in on consolidation. So my key message with this one is please make sure that you really understand your group structure. Things have changed over the last few years. More investments have gone in. Different financing arrangements have gone in. Those might mean that you now control, you have more power when you didn't previously do that. So don't assume that these assessments are a static assessment.
Yeah, I've got a few experiences of that point along the journey, Carmen. And again, one of the phrases which we obviously abide by here is if it's not documented, it's not done. And where it is documented, let's make sure we've read it. So no offence to any lawyers, some of my best friends are lawyers, but often lawyers write documents that support these arrangements without the accounting in mind. You then say, has anyone actually read it cover to cover? Sometimes we feel we're the only people reading this document, and then we find the veto clause or the ability to appoint a board director or a board chair or something like that influences the test of control that Carmen mentioned. So the devil in the detail, the substance of documents over the form of them, and more to the point, oh, but that's not what I asked the lawyer to write. You have to go back and check what has come through in some of these documents. So the power of documentation is writ large with that example.
Yeah, and I think just to kind of expand on that a bit more, Ken, the number of times I get told, but the lawyer said we don't control it, that might be legally the case, but the lawyers aren't giving you accounting advice in accordance with the accounting standards, same as we wouldn't give legal advice in accordance with the law. So we've just got to make sure that we get the right advice for the right purpose by the right people.
And the financial statements are issued in accordance with the accounting standards, not some other legal test. That's the primary objective of financial statements, is why we as accountants get involved in them. Otherwise, what's the point? So yeah, sadly, we do sometimes hear that as well. And again, going back to the preparation bit, the document was available 364 days ago, not necessarily for the first time in the day we want to sign. So get across these things, add that into your planning, particularly if deep down, either as an auditor or an auditee, yeah, we haven't actually read that cover to cover yet. Time to do so.
So we're very much in the theme of enforcement. You can see we've talked about financial statement reviews, audit file reviews, etc. We're going to look at the topic of the minute, and the topic that I have had more questions on in the last month than probably in the last 10 years. That is because ASIC are increasing their focus in relation to non-lodgement and late lodgement. So this started with former grandfathered companies. So you may or may not be familiar with, we used to in Australia have this concept of grandfathered companies under the Corps Act. That was just got rid of very randomly one time in a parliamentary sitting. So those companies then had to lodge their financials, whereas previously they'd had an exemption to that. And ASIC was tracking it to say, oh, well, we're not getting that many of these financials through the door. So they then decided to look at all of the previously grandfathered companies and realised that more than half of them had not lodged. So they went back, they did more investigation. Some of them were no longer in existence, some of them were small, etc. So they contacted them. They also made the comment that these former grandfathered companies should have lodged, and ASIC had the auditors had a responsibility to report to ASIC when they didn't, because it was a breach of the Corporations Act. ASIC then realised that possibly they should go on a bit of a project. So they then issued a statement that said, as a result of this widespread non-compliance, we're going broader. We are going to now focus on all large proprietary companies, not just the grandfathered ones, every one. They then went a little bit further and gave everybody a message, which effectively is what Ken was making the comment to earlier. We've got ASIC saying this is what we're going to do. Companies are advised to proactively review their financial reporting obligations and address any issues of non-compliance before ASIC starts. Now, ASIC have started, but they've also said that this is going to be a 2026 enforcement priority to them, so you still have time. In addition, for those auditors listening, that second sentence is relevant. That second sentence, however, is possibly even more relevant to the companies that are listening. Auditors should advise ASIC if they suspect a company is not complying with the lodgement obligations. Consequently, we've really got that emphasis that the companies need to tell us, but the auditors have an obligation in respect of this too. Let's explore this non-lodgement a little bit further. It's all very well for me to give you that theory, but what does it mean if you don't? So I wanted to talk about two very recent media releases. The first one, and there's been resolution to both of these, which is nice because often I can't give a resolution. The first one was 3 companies that ASIC took to court, referred to court in relation to non-lodgement. 2 of the companies had had the 2024 financial statements outstanding. One of the companies had had the 21 to 24 outstanding. They were all within the same group. The court said that they had to prepare, and the court kept extending the deadline. The 2 companies who only had 1 year outstanding have now lodged their 2024 accounts. They've also lodged their 2025 accounts. They were lodged on time. They then received an infringement notice from ASIC, and that infringement notice included a fine of $187,800. So between the 2 companies, $375,000 fine for 1 year's worth of non-lodgement of their financial statements. Now, we know that the maximum penalty is around that $375,000 per company. So ASIC's view is, well, they have that. We don't know how they pick the number. I know a lot of entities have said to me, it's a $10,000 fine. We'd rather not have our accounts on the public record. We'd rather just deal with the $10,000 fine. We're not talking $10,000 fines anymore. We're talking potentially way more than that. So that, for some of you, may be terrifying enough, the number. The one to me that is more terrifying is the second one. So this is an AFSL company based in Perth, and the two directors were personally charged with aiding, abetting, counselling or procuring this particular company for failing to lodge their financial statements. This went to court, was on the 21st of November, went to court. The two directors pleaded guilty, were both charged $15,000 each, but more importantly, they were charged and pleaded guilty, which means they have a criminal record under the Corporations Act. So consequently, we're seeing that we've got the big fines happening, we've got the names in lights happening, and we potentially are seeing that ASIC are going personally after directors. So this is why we're talking about this non-lodgement space. The next element of this, and we've seen the reference already to auditors, there has been a change in respect to auditors' obligations. So the auditors now, as of from a revised paper issued by ASIC in September, they are required to lodge to ASIC what we know as a Section 311, which is the section of the Corporations Act, to ASIC if they become aware of any non-lodgement of financial statements of any of their clients. The auditors can be fined and potentially can face prison if they do not do this. So consequently, you're going to be hearing more from your audit teams around that lodgement, around their obligations as well as your obligations. Ken, I'm going to throw over to you for your comments on this bit.
Just on that latter point, I hesitate to say this in case our regulator is listening. We have had clients come to us and say, our current auditors telling us we have to do this. If we come to you, do we not? This is the way of the world. The answer is yes, you do. So again, paraphrasing Carmen's earlier comment of, this doesn't apply to us, does it? It does. And the enforcement strategy, the enforcement actions are very clearly mapped out. And for those of you that had the misfortune to enter into a episode with ASIC, the claim of ignorance doesn't work, particularly when they have put this out with such profile. So it's an opportunity to go look at your group structures and understand why you think you don't have to report if that is your current position, and then retest it against this current interpretation. Again, you may think you can do that with a lawyer. I would suggest you'd strongly do it with an auditor and an accountant, given the way this is impacting. And with a slightly selfish perspective, as Carmen has mentioned, if we as the auditors don't do this, then we get fined, and we don't want that. This is an interesting and exciting enough job without the threat of having financial penalties thrown at us for something like this. So it is the way of the world. Don't shoot the messenger. This is our regulators' enforcement priority. We have to all lean into it. So yeah, I probably don't want to say much more than that, but just to echo the seriousness of these cases which are on the screen. And if your answer to that is, oh, but that doesn't apply to me, I encourage you to have a good, long, hard think about that and seek advice accordingly.
Yep. And while we might sound like we're doing a bit of lawyer bashing, and we don't mean to be doing that, and I think in this particular instance, I think that establishing whether you should be lodging, whilst it is in accordance with the Corps Act, it's the accountants, it's the auditors who have more experience with it. What I have found, however, is I said I had a lot of queries on this. I've had a lot of entities who have not been complying. And then we're generally saying you may need to seek legal advice in this instance because potentially it is a breach of the Act, and get that legal advice in dealing with the regulator is actually really important. So let's move away from the regulator for the time being, and we'll move to some hopefully happier topics, maybe. Those of you who've heard me present before know that I don't talk about tax. I'm not a tax person at all. However, I did talk about it earlier in the year, and I'm going to talk about it again. The reason that I'm covering it off here is because I read about this particular case, and my auditor hat and my accounting hat kicked in, and immediately I started thinking about unrecorded liabilities. So this particular case, the New South Wales government authority who monitors payroll tax, the name has gone blank from me, they took Uber to court and said, we believe your drivers could be employees for payroll tax. The initial court said, we agree with Uber. The government said, I'm not so sure about that. And they took it to the New South Wales Court of Appeal. New South Wales Court of Appeal unanimously agreed with the government agency and said that Uber drivers were considered to be payroll tax, included as employees for payroll tax purposes. Consequently, Uber has a debt of $81 million. Uber has now sought leave from the High Court to re-appeal. Now, the general commentary that you read seems to be that nobody's sure if the High Court's going to agree to even hear this, given that the Court of Appeal decision was unanimous and they actually picked a fault in the initial judge's rationale. Why am I talking about this when none of you, I believe, are Uber? Because just have a think about, do you have reliance on contractors, platform-based workforce, forces, freelance professional services, AFSLs with your CARs? All of these could well be caught by this. I'm based in Victoria. The Victorian government is struggling for money at the moment, as I believe is New South Wales. This could be a really easy win for them. And certainly I know that the agencies in those two jurisdictions are looking at this case very, very closely. So I'm not giving you tax advice at all, but I just do want you to start having a think about this, maybe seeking your own legal advice, having a consideration in relation to, do we think this is something that we could be captured by, and therefore could we potentially have a liability at some point? The next thing I just wanted to cover off on was in relation to just a few other contemporary issues. So this is me effectively bringing together lots of the queries that I've had over the last few months and things that I think you should be thinking about when you're looking at your financials. I've talked already a little bit about estimates and judgments. And it's probably the same message I say all the time, is please make sure that those estimates and judgments are specific to you. What we generally see in the financial statements is we'll see useful life of property, plant and equipment, expected credit loss on receivables, impairment of goodwill. You might not even have goodwill, but you're telling me it's a significant estimate that you've made. So just making sure, what was it that took your time? What was it where you had to actually maybe seek advice, maybe have a big discussion with your audit committee to say, where do you want to go on this? We've got a choice, or we've got some different inputs, and there's some judgment around them. That's what we should be describing in here. Not necessarily that we're exactly the same as last year, not necessarily the boilerplate ones from model accounts, ones that are really specific to us. Think about geopolitical issues. We've talked already about hyperinflation, but where are we operating? Do we get our raw materials from a country that possibly in a couple of years' time we may not want to get it from because we've fallen out with that particular country given the current geopolitical environments that we're operating in? Do we operate in relation to the US, and how will tariffs affect us? If indeed they will, who knows, because that seems to keep changing regularly. What is happening in the world that might actually be affecting our supply chain and therefore might have an impact on us? Are we preparing the correct financial statements? So we've talked about lodgement of them. We've talked a little bit about consolidation. If you're still preparing special purpose accounts in the not-for-profit space, that's probably still okay. But if you're not in the not-for-profit space and you're still preparing special purpose accounts, should we be? And do we need to look at that and consider whether that is appropriate? Revenue prior to the non-lodgement issue over the last month is always the issue that I get asked the most questions on. There are so many nuances within AASB 15, and for the not-for-profits listening, within that interaction between AASB 15 and 1058. Generally, I get lots of queries from a new financial controller who's just started and has looked at the revenue recognition methodology and it doesn't make sense. Or in this time of quiet, with no new accounting standards, people have actually taken that opportunity to take a step back and say, how does this sit? Does it make sense? Are we complying with the standards? Do we know what our performance obligations are? Are we recognising revenue appropriately? So I would just encourage you to do that. Control and consolidation I've talked about a few times, so I'm not going to cover that anymore. And then use of AI, I'm actually going to cover in the next few slides. I'm going to jump past that one, but I just wanted it all on one slide for you to think about.
I'll just make a comment on revenue. For those of you who have been to one of these sessions before, you've probably heard it before, but I make no apologies for saying it again. In the vast majority of cases, and every one that I've been involved in, certainly in the listed space, revenue is a key audit matter because it's so important to the operations of the business. It's pervasive, it's material, it's obviously where cash comes in the door. And even if you're not in the listed space, it's something that we always focus on. I'm absolutely not bashing lawyers again, but typically contracts of sale, revenue, terms and conditions are written by lawyers, not with regard to the accounting standards. And the accounting standards do ask us to unbundle it, decouple it, and break it down into performance obligations. So again, but that's not what I wanted it to do. But this is what the document says. So the document is really important there. And again, if you're sitting in a audit role or an auditee role and you haven't read the terms and conditions, that's something to get ahead of now. And again, think about the different revenue streams, because there can be different elements within that. So reading one set of terms and conditions isn't necessarily ticking this box all the way through. So again, the devil in the detail is a message I put out there. And that comes from spending time and reading the documents and assessing what does it actually say relative to the accounting rules in place. Apologies for saying that again. I'm probably going to say it again in June, because it's an ever-present challenge on both sides of the table.
Thanks, Ken. So back in June, we talked about position papers, and I really encouraged you all to start writing position papers and gave you a template. This year, I've probably seen more position papers than I ever have before, which is fantastic. And also ASIC have jumped on the bandwagon, and ASIC have given some comments about position papers in that same report 819. So I've just included some comments in here about what ASIC have said, which is fantastic. I completely agree with it. However, I've added my comments to it. When we do get position papers, whether we're writing them, whether we're reviewing them, we need to make sure that we're actually referencing the right thing. So we are required to comply with accounting standards, and therefore any position paper that is written should refer to accounting standards. Not some random Google references that you found, not some other thing that somebody once posted on a discussion forum, and actually that sounds quite similar to mine, so I'll just take that. We really need to make sure we've got references back to the accounting standards. I said that I was going to talk about AI, and I'm going to cover AI in a little bit of detail now. AI is a fantastic tool. I'm using it to plan a holiday to Europe next year. It's been fantastic for me. However, when in relation to technical aspects, it's not quite so good in relation to that. So whilst I'm not saying don't use it, it can be a great pointer to set you off in the right direction. We very much have to, again, make sure we're looking back to source documents. Now, again, it's very easy for me to sit here and say, don't use AI, make sure you use a technical person, or make sure you actually kind of look at the standard yourself. But I wanted to show you what I mean. So I've got a couple of examples. So the first one, I asked ChatGPT, and this is the paid version of ChatGPT for those of you who are thinking, well, she's obviously using the free one. It's not, it's the paid version. I said, what should I consider in capitalizing software costs? I already have a prompt set up behind the scenes. It knows that it's in relation to the Australian standards. It knows who I am. So it tells me the right standard. Great, AASB 138, fantastic. It tells me that research is different from development. Excellent. So it then tells me that capitalization can only start once the project is technically feasible. Correct. That is one of the 6 criteria. Has documented approval to proceed. No, that's completely made up. And there's evidence of expected future economic benefits. Yes, that's another criteria. And we need a reliable way to track time and cost. Kind of, it's got one of them. However, there's 6 criteria that have to be met in AASB 138 in order to be able to capitalize software. So again, if you look at this, and this is when I say that a lot of the papers I'm seeing have been written by AI, because I've got this information that's given to me. I had one in relation to capitalization of software costs, and there was 6 criteria, but they weren't the right criteria. They were completely made up. And it's making sure that when we've got this, we go back to the standard and say, have we done it appropriately? Another one is questioning for those not-for-profits in the room. And I asked the question, how does a not-for-profit account for concessionary leases under AASBs? The 2 queries that I've picked, I had real-life examples in relation to them. So that's why I wanted to test and see what it actually gave me. Now, again, this looks like a super comprehensive answer. This would be the position paper. This is amazing. I could just copy all of that. However, what it does is refers to the right standard. It refers to the right paragraph numbers, but it doesn't tell me there's another paragraph underneath that says something different. So this tells me that the right of use asset for a not-for-profit with a concessionary lease has to be measured at fair value. And in this instance, the client called me and said, we don't want to measure it at fair value. What do we do? The answer is you just use the exemption within the standard that we've got. So consequently, if we're thinking about this, it looks comprehensive, but we have to go back and check the source documents. So I'm off my soapbox now in relation to position papers and technical queries in relation to AI, but I did want to just explore a couple of other things, particularly in relation to the ethics. So there is lots of discussions happening at the moment around ethical use of AI, both in the accounting space and also in lots of other spaces. So thinking about what policies you have in place to make sure that your employees are using AI ethically. And as I was exploring this, I wanted to see what else was out there, guidance. So the government have actually just released a guidance for AI adoption, which sets out 6 practices for responsible AI, and I've put the references there. There was also a recent survey that was done by the Governance Institute in relation to where does AI sit in respect of ethics. And as you can see, it has jumped to the 3rd most pressing issue behind cost of living, housing affordability, and equal to embryo experimentation, which I found, again, quite fascinating that it really has received so much focus now than we used to. Again, I said I was off my soapbox, but I've got another few articles that I just found that I thought would be relevant. We see all you have to do is Google how was AI being used and how did AI get it wrong or something like that. We've got that there was an article that was issued, a fake article that said that going forward, we had to keep our headlights on all the time and we would risk a fine if we didn't. Didn't exist. It was completely made up, but apparently it was all over social media and there was uproar about it. We've seen some recent issues around consultants that have used AI and were found to be wrong. Very major high profile in the government. We've seen contractors where there were spreadsheets that were updated to AI and all the public information was released. So we just have to be super, super careful around this. As I say, I just wanted to pull in just some different things to get you thinking about this. In the legal practice, we feel like we've talked about lawyers a lot in this session, but the legal firm has actually put out a statement on how lawyers should use AI as well. So it is definitely a high profile element. Ken, that was it from me. So I'm happy to flick to you for any other comments, questions that might have come through.
Well, thank you. Thank you as always, Carmen. We're going to do a quick shift of the deck to bring in Jim. As I do that, we could probably talk about AI and ethics for some time. I guess I'm going to give some gifts out at the end of the session. Here's the first one. The gift from AI and ethics is that you are actually all auditors, even if you're not sitting in an auditing firm, because you have to verify what you have found on this, in the same way that you wouldn't have just trusted Google wildly. You have to earn the right to rely on what AI is coming with, whether you're using it for a position paper, whether you're using it for an interpretation of a standard, whether you're booking a holiday, because you might don't want to book a holiday in a hotel that doesn't exist, Carmen. So you're actually all applying the same auditing logic that we love on our side of the fence. So I'm sure we'll talk about that in future sessions. Carmen, I'm going to draw your attention to a question in the chat box. If I could ask you to think of that as we conclude Jim's session. And with no further ado, pleased to welcome back Jim Allenby, our ESG leader, to tell us the latest thinking in this space, because it's all getting real, Jim.
Sure is, Ken. Thank you very much. And thanks, Carmen. That was wonderful to listen to. I won't be mentioning lawyers much, so we should have a good balance between us. With this session now, I think we're a little bit short of time, so I'll race through quite a bit of it, especially for the first half. A lot of you would have seen a number of these slides at the start, so I'll jump straight into it. That's just a bit about us, what we're doing, and just to give context, I guess we're working across pretty much every industry at the moment, with all different sized businesses. I guess that's the context from this slide here. Also appreciate this will get shared afterwards, so I won't talk to each slide for the sake of time. It's me in better days. And then in terms of just the reporting landscape itself, you've all, if you haven't seen this graphic around the reporting entities and which group you fit into, it probably is quite a good time to start looking at that. I'll assume, hopefully correctly, that most of you are aware, if you are a reporting entity, when the dates for your reporting period arise. what is actually being reported, and this is one of the learnings probably over the last 12 to 18 months, and I refreshed the deck from this time last year, Ken, when I did this session for a similar update. And I guess one of the things I've been highlighting a lot over the course of the year in various workshops and various presentations on this topic is it's really making sure we understand that this reporting is around the climate-related risks and opportunities that a user of a general purpose financial report. So what we're seeing a lot in the market at the moment is a bit of confusion that this reporting is just your emissions only. And I think one of the things I just want to be really clear on today, and always happy to answer any questions or to go into more detail at another time. Yes, this reporting does include your emissions, does include carbon accounting, but the reporting itself is more based around the climate-related risks and opportunities and how that affects the business from an investor point of view. And I'll go into touch more detail on that shortly, but I just really want to be clear on that because we're going to a number of Group 1 and 2 companies and now Group 3 companies that feel like all they need to do is get their sort of carbon accounting ledger up and running. And unfortunately, or fortunately, there's a little bit more to it than that. So the guidance that is also there on the screen now is if a Group 2 company hasn't started preparing for this reporting, we're starting to see that it's going to become a little bit difficult from a time point of view. And we certainly suggest that if you're a Group 2 business, there should already be some work underway as to not put any undue sort of stress or pressures on the business from both a resourcing point of view, but also just a time it takes to get some of this reporting data into the correct location. Group 3 companies, which we're seeing a lot more of now, which is fantastic, using this year to slowly implement this across the business. And we're seeing some great results from that approach to take their time, start early, start small, rather than starting late and having to do a lot all at once. And frankly, if you're a Group 1 entity and you haven't started preparing for this, I think it's going to be quite difficult. There is going to be some stressful sort of periods over the next few months. So if there's any Group 1 entities out there, and we do have a couple that we're working with that have only just started for various reasons, I would suggest that it would not be as festive a period if we're not underway already. And just that last point, in our experience now working with, around 50 organisations, it is taking around 2 years to get this reporting implemented and reoccurring, and in a manner that we feel gives decent comfort internally to the CFO and the board, but also when it makes its way to your auditors for assurance. How is it being reported? So as mentioned, the metrics and targets are where the carbon accounting sits, but it's in this order for a reason, starting with governance. So the process, controls and procedures that the entity has to manage climate-related risks and enhance opportunities. Very important part of these reporting is around the governance. Ken mentioned earlier, if it isn't documented, it doesn't exist. And we're certainly encouraging every organisation we're working with, start documenting that it's being considered at board level, which feeds into strategy. Once again, sits with the directors and executive level. The strategies the business or the entity are looking at to manage and enhance these climate-related risks or enhance the opportunities, manage the risks. The risk management process, which to be honest is probably the most not simple, but it's the part of this reporting that we're finding companies have probably the best chance of being able to get some great results early due to existing risk management frameworks. And we're seeing some really good results of being able to implement climate into existing risk management frameworks and processes. So we're really seeing that as a really a high value part of this reporting, and to be honest, one of the more straightforward, transitions for a business that is already a reporting entity. And then metrics and targets. So this is where we're seeing the carbon accountings coming in. We're seeing the targets for the future, and things like scenario analysis, which I'll touch on shortly as well. Just to emphasize the order in which that's written, absolutely starting with governance. The reporting framework itself, and once again, I've seen a lot of, surprises from people when we deliver these sessions. This sustainability report does sit as part of the reporting, reporting pack of previously 3, soon to be 4. So that financial report, director's report, auditor's report, now we're seeing the sustainability report coming into that suite of reporting. And, the year-end reporters now, literally a couple of weeks left to go, and then obviously announcing or handing in their reports. this tends to be the point where most CFOs, most directors start paying a little bit more attention, or a lot more attention, I should say, now that the climate statement informing the sustainability report is part of the traditional financial reporting. We're seeing directors having to declare and sign off on this statement and various notes. We're seeing it going to the audit and assurance professionals. So this is really where it becomes a real topic that's being treated as such, and probably where we're starting to see a lot more businesses probably activate their sustainability report a little bit quicker when they understand it forms part of traditional reporting administered by ASIC, and you know, it's a real report, not a 100-page glossy magazine that a lot of people, I guess, assumed sustainability and ESG reports may be, or perhaps were in the past. Another big learning we've had over the last year is around the supply chains and the impact on supply chains. So those not in Group 1, 2, or 3, but particularly those supplying into Group 1, starting to get asked for more information, starting to get asked for their Scope 1 and 2 emissions when delivering services or goods and services into Group 1s. We're seeing Group 1 entities asking their supply chains for more information, whether it's emissions, whether it's policies, whether it's a little bit of strategy as well, generally, especially for longer contracts. So a real, I guess, emphasis on the smaller SME side of town now to be able to supply correct information up to the reporting entities. And the cleaner and easier that information is to, I guess, input into the reporting entities' data systems, the more we're seeing they're having a competitive advantage in the market. So just a real obvious advantage to a business, especially those supplying into Group 1s and 2s, if they can supply data in a way that the receiving entity can certainly implement quickly and easily. As I said, I am racing through this. So one of the learnings from the various roundtables I've attended with ASIC and the AASB and IFRS foundations, we're starting to see ASIC's role in this reporting and ASIC's role in this legislation and as the administrators of the framework. So ASIC I think the first thing to say, ASIC are going to have an approach that isn't trying to blame or trying to catch people out, but there will be a pragmatic view from ASIC as long as the correct processes and systems have been followed and the correct, I guess, effort and attention has been put into this reporting. ASIC do have a huge amount of information on their website. I've become very familiar with the Regulatory Guide 280. I didn't know that existed probably 5 or 6 years ago, but it's become a regular on my tabs on my computer now. So there is a huge amount of great information on there around the AASB S2 reporting requirements and ASIC's approach to administering this framework. So I'd very much encourage you to have a look at that. There is some summaries that we've put together that have been shared, and if you would like that to be shared, please reach out with a summary of the various parts to that guide. But they're very much there to support transparency is a really strong message that we have received from ASIC and through these various roundtables. So the point of the sustainability reports is to have high quality data, is to have a transparent look for investors into a business as to whether it's a good investment and if it's a business that's set up for the future way in which we will be doing business. Unfortunately, as per Carmen's presentation as well, there is penalties for non-compliance. It is relatively unclear exactly what these will be, but the feedback we've got through the various sessions I've been to is it is going to be, like I said, there will be a pragmatic view on this, but there is also going to be, I think, some penalties for entities that are just ignoring it or aren't putting the correct amount of attention or resources into this. There is a proportionality aspect to the administration of this regulation and also the penalties. So on the screen there, you'll just see there is some large numbers. I'm not 100% confident that the first few businesses will have multi-million dollar fines. I think you'd have to see some fairly significant negligence for that to happen. But the point is that this is a penalty that ASIC will be handing down. Directors will be facing personal liability, which, as Carmen mentioned, can be a lot scarier than the financial penalties themselves. As mentioned, there will be a pragmatic and proportionate view on this from ASIC. There is some guidance on that 280, so please have a look at that. If you are a director or you are advising directors, there is some great information on that website. And in terms of the immunity and compliance importance, so there is some immunity for particularly parts of the reporting elements. I think commercial sensitivity is a strong message we've been receiving from the regulators. Clearly, we can't be putting information out in the market if it's going to affect the business from a commercial point of view, or if there is IP protection, etc. But once again, doing the work, documenting it, explaining why it's sensitive information is certainly encouraged by all of us. Guess some advice and once again some feedback for the finance professionals out there. There is some financial implications of this reporting. There is increased reporting costs. There's no way of going around it. It's a fairly significant process to undertake to get this reporting in place. So we're encouraging businesses, especially Group 3s, but Group 2s as well. This will need to go into your own financial forecasting as a cost. There is hopefully some internal resources you'll use within your business, but almost certainly there'll be some external help required. So, please consider that increased reporting cost. Impact on finance access. So this reporting does sit with the finance team of a business. Yes, it'll sit if there's a sustainability function. They'll obviously be a part of this process, but this reporting does end up with the finance team, whether it's the CFO, finance director, finance manager. Various companies have different functions, but this reporting does always end up with that team. So once again, just making sure we have, the resourcing in place from a time point of view as well. Making sure the CFO is really across this topic in general, and as well as the board and the directors themselves, there is a financial oversight because it is a financial reporting requirement. And enhancing transparency. So it's just around trying to make sure the data is as clear as possible, make sure that we're, once again, documenting all the things that are in place, and just trying to make sure we're seeing that long-term value is being created by having great data that can support decision-making. Some suggestions for CFOs or finance teams. Once again, not trying to blame people for not getting this in place early enough, because it's something that I and my colleagues do every day. I know other people have many other things on their plates. We are seeing a lot of businesses coming relatively underprepared for this reporting and coming in late. So I'd just strongly encourage you, if you've not started doing anything, please do something, even if it's something small. The things like gap analysis are relatively straightforward. There's some great tools out there. It's what we spend most of our time doing. Having that implementation roadmap, so being able to assign tasks to the correct person in the correct order is something that's very important. So I just want to emphasize the order in which some of these tasks are done is just as important as the tasks themselves sometimes, because strategy needs to be informed by great data. And sometimes what we're seeing is an incorrect order means having to do it all over again, and no one wants to do this twice. I'd strongly encourage you to engage the insurance providers. People like Ken are very across this topic, and good auditors and good assurance professionals will be across this topic. So please engage with the audit providers and insurance providers as soon as possible, just to get that, that feedback and start getting some comfort. And just on the climate scenario modeling, it is the part of this reporting that does take the most time. It is the part that goes across most parts of the organization. So just a really strong encouragement to start looking at the amount of time that scenario modeling may take, and starting to factor that into workflows for probably early in 2026, if not already. So just to wrap up, and whirlwind tour of sustainability, current budgets rarely reflect this requirement. There is a financial aspect to delivering this reporting. What we are seeing is not many companies have factored this into their budgets in the future, so please consider that. Controversial one, but it is often an unpopular topic, especially with boards and directors, often with CFOs who see it's a cost with little benefit. So don't be disheartened if this isn't all sunshine and rainbows, and we need to have the conversation maybe more than once. Internally, finance, HR, legal, often commercial, health and safety. So it's a multidisciplinary approach to getting this reporting done. But at the end of the day, the finance team will almost certainly be the team that is responsible for that. Preparation for the first report does take time. It is new for everyone. So please allow that time as much as is possible. The more time you allow, the less externals you will need is the general rule. And just to emphasize the point that the reporting is not just greenhouse gas emissions only. Those 4 reporting pillars of governance, strategy, risk management, and then metrics and targets are what the reporting is actually encompassing. The carbon accounting is a huge part of it, yes, but it's one of the 4 pillars. And just, I guess, for the auditors and assurance professionals that will get this at the end, the preparation method and process and documentation is very important. The first report won't be perfect, but we just want to make sure we're giving our audit friends, if that's not an oxymoron, as much of an opportunity to be able to see how we've got to the outcome we have when it's their turn to do their part of the work, when it does get to limited assurance, then full assurance. And just to strongly encourage education and awareness, identify some key people in the organisation, and a really strong message that we've seen come out from the regulators that this reporting is climate first, not climate only. So those processes and systems that are built now certainly isn't time poorly spent. It will likely be followed up with the other parts of ESG and likely followed up with things like nature-related disclosures and the like. So a strong focus on processes and systems. Last one there, which, as I say, these slides are almost certainly going to be sent out. There's just a handy, I guess, checklist there for you. If you're unsure if you need to report, there's some just generic questions you can ask yourselves internally. And if there's a lot of yeses there, it's likely to start getting ready to report. So I think I managed to claw some time back there, Ken.
Excellent, Jim. Well done. That's a sustainable way of managing your topic. Thank you. We will continue this discussion on ESG through your PKF contacts, partners, engagement teams, or anyone you've seen on this call today. Please continue the discussion. We'll be holding dedicated sessions in each of the capital cities in early 2026. We'll be doing a standalone webinar on this as it develops. Please continue to engage in this topic, and we are here ready and willing to give you whatever support you need within the independence rules. Carmen, could I ask you to check back on that question that we received in the chat box?
Yep. So the question that we got was, if a reporting entity is in administration, is there any exemption? So we're assuming that's an exemption from 311 reporting from the auditor. No, is the short answer. So potentially there's a report that the entity is trading whilst insolvent and also late or non-lodgement. And I think, Ken, we got a question before about tier 3 in the not-for-profit. So I might just cover that quickly.
Thank you.
The question was around, do we know, effectively I'm summarising, but do we know who tier 3 in the not-for-profits will apply to? The answer is no. At this stage, we're expecting the standard to be issued in the first half of 2026. But until the regulators come out and say who can use it, we don't know anything else about it at this point. So it will be we'll cover it in June next year.
Excellent. So thank you to Noel for tabling that question in the chat box. Noel, within the festive season and gifts, you can have 1 hour free consultation with myself and or Carmen of your choosing. Conditions apply, other devices available, but you can reach out to us in recognition of providing that question. My second gift is remember to audit all your AI outputs. So, hey, look, we're all auditors. And finally, just again, the common theme around planning and preparation. We do have discrete roles as auditor and auditee, but teamwork will get us there. And given the time of year, the epitome of teamwork is Santa Claus. And I wonder if you know why that is, because they do all the logistics, they get the toy factory out, they get everything out there on time all around the world to those of us who have behaved. And they're able to do that because of policies and procedures. And in that, it's because in those policies and procedures documents, Santa relies on the subordinate clauses in those documents. I gift you that Christmas cracker joke. Have a great festive season. Stay in touch with your PKF colleagues, and we look forward to seeing you again on the other side of the year. Thanks.